oil below $75 a barrel, bond yields down 23 basis points, small caps up nearly 4% in a month. Welcome to the July investment strategy with Mira Asset Shekhan. I am Pooja and with me is Vishal. Stay with us till the end because we'll also walk you through 5 model portfolios for different investor profiles. Vishal, one event seems to have driven all of this.
It did, Pooja. The interim US-Iran peace agreement. The moment that deal was announced, the fear of an energy supply shock faded. Brent crude slipped below $75. Traffic through the Strait of Hormuz resumed and risk appetite came back across markets. For India, cheaper oil means lower inflation pressure, a stronger rupee, better fiscal math, and better corporate margins. So this is the single most important macro driver right now.
Let's start with how our markets did in June.
It was a positive month overall, but the leadership was narrow. The Nifty Small Cap 250 TRI gained 3.74%, clearly the best performer.
The Nifty 50 rose 2%. The Nifty 100 rose 1.76% as on 29 June 2026. The surprise was mid-caps. The Nifty Mid-Cap 150 returned just 0.56%, the weakest of the lot. And what about sectors, Vishal?
A very clear split. Banking led everything. Private banks gained 6.9%. The Nifty Bank 6.8%, and even PSU banks rose 4.9%. Media, financial services, and realty also did well. On the other side, IT fell 7%, metals fell 6.3%, and commodities fell 4.4%. So money moved into domestic growth sectors and out of export-linked and cyclical names.
Markets keep climbing, so the obvious question investors are asking is, are valuations becoming stretched?
The data says no, not yet. The Nifty 50's forward PE is at 19 times, unchanged from last month and below its 3-year average of 20.4 times.
And that tells you something important. This rally is being driven by earning upgrades, not by people paying more for the same earnings. Valuations are reasonable. Vishal, what about foreign investors? They have been sellers all year.
Yeah, they have. FI outflows have crossed rupees 3.3 lakh crore in 2026 so far. But two things are worth noting. The pace of selling has slowed over the last 4 months, and domestic institutions, your mutual funds and insurers keep buying. DI inflows have absorbed the entire FII supply, which is why corrections have stayed shallow. Pooja, can you give us the global picture now? Fed first.
The Fed held rates for a 4th straight meeting and still sounds worried about inflation. Markets expect at least one more hike this year, even though the Fed cut its own 2026 US growth forecast from 2.4% to 2.2%. That's why the dollar index stays above 100. Japan moved the other way. The Bank of Japan hiked 25 basis points to 1%, its highest rate since 1995. On a 7:1 vote, but with oil falling after the US-Iran deal, the pressure on both central banks eases a little. Closer home, the RBI met in June. Could you walk us through it?
The repo rate stayed at 5.25% with a neutral stance, exactly as expected. The interesting part was the forecast. GDP growth for FY27 was cut to 6.6% from 6.9%, mainly on geopolitical uncertainty. Inflation for FY27 was raised to 5.1% from 4.6% on higher energy prices and the risk of below normal rainfall. So growth down, inflation up. Even at 6.6%, though India remains among the fastest growing major economies, the RBI also announced a package to attract foreign capital, more FAR eligible government securities, easier norms for non-resident investors, support for FCNRB deposits, and the export realization period restored to 9 months.
And the actual inflation prints?
Retail CPI for May came in at 3.93%, up from 3.48%, with food at 4.78%. Still, within the RBI's comfort range, the number to watch is wholesale inflation. WPI jumped to 9.68% from 8.26%, with fuel and power inflation at 30.33%. That's input cost pressure building in the pipeline. On the positive side, industrial production grew 5.1% in May, with capital goods up 12.9% and electricity up 9.9%. Bond markets had a good month too, right, Pooja?
A very good one, Vishal. The 10-year GSEC yield eased to 6.77% from 7% a month ago, a 23 basis point drop. Lower side, the RBI's liquidity support and its foreign inflow measures all helped. Call rates also eased to 5.34%. Before we get into our strategy and model portfolios, we'd love to hear from you. Comment below which part of the market are you most bullish on right now: large caps, mid caps, or small caps? So, bringing it together, what's the strategy for equity investors, Vishal?
4 points. First, our in-house quantitative asset allocation model favors mid caps and small caps, followed by large caps. Second, invest in a staggered manner through SIPs or tranches rather than deploying everything at once.
Third, keep gold in the portfolio as a strategic hedge. Fourth, add some global diversification through Gift City outbound offerings. And on the debt side, Vishal?
Yields should stay largely range bound from here, so we prefer accrual oriented strategies and shorter duration funds which earn the coupon without taking big interest rate bets.
Now, the part many of you stayed till the end for, the model portfolios. These are 5 model portfolios built for different risk profiles.
Correct. The aggressive portfolio for investors comfortable with volatility holds 20% large cap, 40% mid cap, 25% small cap, 5% flexi cap, 5% thematic, and 5% gift outbound.
The moderate portfolio balances out with 20% large cap, 22% mid cap, 10% small cap, 15% balance advantage, 23% in corporate bond and short duration funds, 5% gold, and 5% gift outbound.
The conservative portfolio is debt heavy, 70% corporate bond and short duration, 20% balance advantage, 10% gold.
And the 2 special baskets?
The regular income basket for lump sum investors seeking steady income holds 70% balance advantage and 30% multi-asset funds. The Build India basket for high-risk investors who want the domestic growth theme holds 80% in thematic and sectorial funds and 20% in flexi-cap and multi-cap funds. The specific scheme names for each basket are in the full report, so do read it along with each scheme's riskometer.
Before we close, what's the one risk that could spoil this setup?
The monsoon. El Nino conditions raise the odds of below normal rainfall. That would hit agricultural output, push food prices up, and weaken rural demand. It's the key risk for both inflation and growth.
Persistent FII selling and dollar strength are the other 2 to watch. But as long as crude oil stays at moderate levels and geopolitics stay contained, Indian equities have support from domestic flows and structural growth.
So to sum up, a positive June led by small caps and banks, reasonable valuations, a cautious RBI, and a strategy that favors mid and small caps with staggered investing and a gold hedge. Thank you and happy investing.
Mutual fund investments are subject to market risk. Read all scheme and related documents carefully before investing.